Vanguard just cut the fee on VWRA. This is one of the most popular ETFs Singaporeans invest in, and now it only costs 0.14% a year to own, down from 0.19%. So does this now make VWRA the best all-world fund to invest in? Not quite, because there are still even cheaper alternatives. In this video, I will show you what all this means for you and which fund should you put your money in. Let's jump right in. So why did Vanguard suddenly lower the fee on its own flagship products? Is it because they are feeling generous? Of course not. Instead, it is because over the last year or so, there were a number of brand new all-world ETFs that were launched. And even though they are new, all their fees came in cheaper. So all of a sudden, Vanguard was not the cheapest kid on the block anymore. Heck, even without the brand new funds, Vanguard has always been one of the more expensive funds to invest in, even though its mission statement says that it will always put investors first. And so, for a long time, Vanguard has kept its fees on VWRA at 0.22%, while the fund got bigger and bigger. Investors know this, so they started going with other funds instead. In 2020, Vanguard was taking up to 86% of every dollar going into world ETFs in Europe. But by 2025, that was down to 53%. As a result, Vanguard started losing market share. Back in 2021, Vanguard was holding 64% of all the money sitting in these funds. Today, that has dropped to 55%. Meanwhile, iShares' share has climbed from 12% to 26%. Because of that, Vanguard decided to not so generously cut the fees. Not once, but twice, bringing the fees from 0.22% down to 0.14%. But how does VWRA's new fee stack up against its competitors now? Here, we have the four main US-denominated all-world UCITS ETFs that you can buy on the London Stock Exchange. The first thing you will notice is that VWRA's expense ratio sits roughly in line with its competitors now, with the exception of ALLW. If this is the first time you have heard of ALLW, that's because it is a very new fund that has only just launched in April this year. And despite being that new, it is already charging just 0.07% in fees. Most of these funds track the FTSE All-World Index, which holds the large and mid-sized companies in both developed and emerging markets. The only exception is ACWD, which tracks a different index called the MSCI All-Country World Index. The main difference is that while FTSE tracks 90% to 95% of the market, MSCI ACWI only tracks around 85%. As a result, VWRA has close to 3,800 holdings, whereas ACWD only has around 2,300. But how does this affect the returns? If we start from 2019 when VWRA was first launched, we can see that both VWRA and ACWD gave almost exactly the same performance. So even though ACWD was holding around 1,500 fewer companies, it barely made any difference. Then if we move the start date to 2023, when FWRA was launched, we can again see that the performance of all three ETFs is almost identical. Likewise, if I bring the start date right up to April, when ALLW was launched, all four ETFs are again sitting on top of one another. What this means is that whichever ETF you pick here barely matters, as they all end up in more or less the same place. It's like choosing McSpicy from McDonald's or the Spicy Chicken King from Burger King. Both will also give you lao sai. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. So then, if all four give you almost the same performance, why not just go for the cheapest fund, ALLW, which only charges 0.07%? The thing about ALLW is that it is brand new. As of making this video, it is only about 3 months old, which in human terms is basically a baby who's still drinking milk and pooping his diaper. It only holds around $70 million in assets, while every other fund on this list is holding billions of dollars. As a rule of thumb, an ETF is usually only considered established once it clears at least $50 million US. Anything lower than that, there's a higher risk of the fund getting shut down. And right now, ALLW is just barely over that survival floor. Not only that, because of how new ALLW is, its trading volume is also a lot smaller. On an average trading day, ALLW only trades around 3,600 shares, while VWRA trades over 200,000. That's roughly 60 times the trading activity. This lower volume affects the gap between the buying price and the selling price. For example, ALLW's spread is around 0.17%, while VWRA, ACWD, and FWRA are all far tighter, sitting at between 0.01% and 0.03%. What this means is that when you buy ALLW, you will be paying a bit more just to get in. On a $10,000 investment, that's about $8.50 in spread cost versus about 50 cents on FWRA. Alright, let's put it all together. Which all fund should you invest in now? Obviously, it's your money, so you have to decide for yourself. But here's how I see it. If I'm already investing in VWRA, I will stay with VWRA, simply because VWRA's fees are lower now and are virtually the same as the other more established funds. Over a period of 40 years, assuming that you invest $1,000 a month at 8% return, and assuming that their fees never change, you will end up with about $16,759 less in VWRA than in ACWD. And while that might sound like a lot of money, just keep in mind that this is over 40 years. By then, your portfolio could even be sitting at over $3 million. So we are really talking about a difference of 0.5% here. Because of that, I don't think it's worth selling everything just to switch over. You would be paying the commissions and the spread, and sitting out of the markets while the money moves across, or to save on an amount that you probably wouldn't even notice in 40 years. But what if you aren't invested in VWRA yet? Which fund should you go for? Personally, I would rather be a little cautious here and just go for ACWD instead. That's because even though ALLW charges the lowest fee of the lot, it is still quite new, and I would rather not put my retirement money into a fund that hasn't proved that it can survive yet. However, once ALLW has crossed the $100 million mark and builds up a couple of years of history, that's when I would really consider relooking at this again. In short, VWRA has just lowered its fees, but rather than jumping to every cheaper fund that comes along just to save a few dollars here and there, it is a lot smarter to just stick to one solid proven fund and keep buying it. Market up, you buy. Market down, you cry a bit, then you buy more. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.